Welcome to Non-Consensus Investing. I'm Ram Alawalia, your host and CIO at Lumina Wealth, where we specialize in the craft of alternative investments. At Lumina, we help guide clients through the intricacies of managing substantial wealth so they don't have to shoulder the burden alone. Through this podcast, we draw back the curtain to reveal the strategies employed by the best in the business for their high net worth clients so that you too can invest beyond the ordinary. All right, welcome to our next edition of Lumina Non-Consensus Investing. You can find us on Spotify, YouTube. We're doing clips now on Instagram, TikTok, Twitter, anywhere you can consume content. We are there. I'm really pleased to have back a repeat guest. Michael, you might be like our first repeat guest. Actually, Frank Rotman was our first repeat guest from QED. So we're pleased to have you back. Michael is a world-class analyst. Goldman Sachs retired partner, was studying internet back there in the late 90s. And you really saw this industry grow. You helped take LoudCloud public, for example. Of course, that was founded by Mark Andreessen and Ben Horowitz. And now they started a VC firm called Andreessen Horowitz, which has become a real dominant presence. So you've done quite a bit. Thrilled to have you back. So I reached out to Michael. Thank you. I reached out to Michael last night. I was like, hey, Michael, we've got Google earnings tomorrow, Tesla earnings. We've both separately done our prep and homework on these. So we're going to cycle through that. And maybe we can get to other topics like CrowdStrike and crypto and who knows what else. We'll see where it goes. Let's dive right in. So let's start with Tesla and Elon. Michael, what are your initial reactions?
He's done an amazing job, obviously managing both the operational aspects that they've had to manage in terms of the productions, the issues with China, and then managing expectations in the context of full self-driving, robotaxi, and the robots. And he did a good job on the call yesterday, continuing to paint the long-term picture and prospects for those things. At the same time, the reality is the near-term issues are the near-term issues. And that is some of the things that are reflected in today's market action, but recognize, and I'm sure, and you've pointed it out in your tweet stream, the company's basically gained a Toyota in the last few weeks in terms of this mini rally that they've had from $195, $96 to $50. So it's, to me, it's the biggest meme stock of them all. It puts the GMEs and the AMCs to shame. It's the super duper version and a supersized version. Not because I don't agree with the fundamental directions that they're going in terms of EVs and full self-driving. It's just that it takes a long time. And the markets are, especially the professional investors, my former peers, et cetera, when I look at what comes out of the Wall Street houses in terms of their assessments of the prospects for robotaxis and prospects for robotics and how they add it on as a sum of the parts exercise to the valuations of Tesla, having been focused on internet and PC for 30 years, to me, all of those things have to be taken with a lump of salt because these things take so much longer than people think. And that sometimes does not come through in the stock volatility.
You're nicer than I am. I have a very critical take on the earnings call. Let me actually play a snippet of this call. The tone and the energy that Elon had, I thought was very low. Of course, the day before, he had an interview with Jordan Peterson. But take a listen to this. This is Elon talking about humanoids.
Version 1, limited production starting early next year. This will be for Tesla consumption. It's just better for us to iron out the issues ourselves. But we expect to have several thousand Optimus robots produced and doing useful things by the end of next year in the Tesla factories. In 2026, ramping up, and at that point, we'll be providing Optimus to outside customers. That'll be production version 2 of Optimus.
So look, it was low
you
energy.
Go first, I'll follow.
Yeah, low energy, very halting. So just to recap, what he said is, hey, humanoids are in production, exciting, but Tesla will be the initial consumer, which means they're really not for commercial ready purposes, and wait until 2026. By the way, it looks like robotaxis are getting kicked out also. So it's yet another pattern of selling the future, seems to me pump the stock. And then there's like the rug pull where it get kicked out. And that's happened again here. And he said like humanoids have quote unquote basic factory functions. If you recall, The CFO call, I want to say 2 or 3 quarters ago, he mentioned around humanoids. He said, we're still looking for a use case. And then Elon intervenes right there. It was like, I think that's the issue is where's the delivery? Where's the commercial traction? Where's the earnings growth? This stock is the highest valuation in Mag 7. It is over twice as expensive as NVIDIA on a forward PE basis. And it's got the worst margins in the business. And the margins have compressed 6 quarters in a row. And now they're facing the threat of competition from international players like China that can produce these efficiently. And you've got players like Fabric in Texas. So I think he's got a hard hand to play here.
See, the humanoids, they sell well because people know this from science fiction. We know what humanoid robots are supposed to do, mostly bad things. We seldom have seen, other than the Jetsons, we haven't seen robots actually do anything except in the cartoons where they make food and clean the house and that sort of thing. The issue here is that in an environment where after over a decade plus promising a $20,000, $30,000 EV, the notion that we're going to have humanoids in our house or in our businesses that are going to be the 10, 20, 30,000, which are the price points he's directionally pointed out, are not realistic, because you look at, I've spent a lot of time with the robot market in the industrial market, right? Traditional robot companies that have been selling robots that are $100,000, $200,000, $300,000 from a range of companies for the last 10 or 20 years. And there's an immense amount of complexity with them. It's literally, if you again compare it to the car market, what Google has done with Waymo, every one of those Waymos driving around in San Francisco or LA or now in Arizona, etc., those things have sensors that traditionally have cost hundreds of thousands of dollars. Those things are $200,000-$300,000 platforms. They're a long way before the LiDAR stuff, exactly. And so that's issue number one in terms of just the cost and getting it to a consumer point when Elon says, hey, where this is going to be a big market. And I've seen Wall Street reports from institutional firms that point to the humanoid robot market as a bigger market than automobiles, which again, over a 10, 20, 30-year period, we may get there. But I think you touched on a key piece. What is the use case? What are you going to use these things for? We barely have figured out what to do with the Roombas running around. And Amazon tried the Astro and then they killed it because they were losing billions on Alexa, and they're redoing that business. And Jeff Bezos is gone now. He's not focused on that Alexa, and the robot piece, the home robot piece is gone. The last thing I'll point out on the robot side of the equation, humanoid robots, is there's a big transition going on, just as you'd imagine, from traditional robotic software, the Boston Dynamics of the world. Their software stack is traditional machine learning. And when you go into the weeds of how this stuff works, it's just in the last year or so, after the ChatGPT moment of OpenAI, that the whole world of robots is moving into generative AI, or large language model foundation robotics, it's called. And Jensen Huang of NVIDIA has talked about it a lot, and he's got some interesting platforms around robotics that he's putting out. And those are tech stacks to look at, and they're interesting, and we can put up some details on that later. But where I'm going with this is that investors generally assume that because Teslas have this huge Hoover vacuum of 2 million Teslas with their cameras basically providing all this data, that data is not it does not transport over to the world of the physical economy in your houses and your factories. We need whole new pools of data, and there is no easy mechanism to capture that data initially inexpensively and then train the models around that. So Tesla, I'm sure with the humanoid Optimus robot program, they're doing a lot of synthetic data creation, etc. But we are a long way from any real usable data on humanoid robots.
Elon is running 5, 6, 7 different companies, and Tesla itself has 3 or 4 different companies with distinct bets. And yes, there's some common themes around there around AI, and they got to buy NVIDIA chips, but the engineering challenge they have are significant. And look, the use cases are known. It's helping elders, helping take out the trash, helping prepare food, diaper care, all the rest. But it's the engineering is going to take some time. And when the valuation is at $700 $90 billion market cap. My approach is you can't give him credit. Gene Munster made this interesting point. Gene is a tech analyst at Piper Jaffray. We've been on the opposite sides.
I've known Gene for decades, and we used to cover American Online and all these other things together. So I know Gene very well. Yeah.
So Gene had this comment last night. He said, "Hey, I see Tesla as a $2-3 trillion company in a few years. It can really grow from where it is today." I have the actual opposite view. I think Tesla is probably a $50 billion company. I don't know, maybe $200 billion market company. And one day it can grow into being a $790 billion market company, which is where it is today.
So if you look at just this call, right after the call, look at Elon tweeting. He test marketed. He flew a trial balloon he saw of potentially Tesla lending $5 billion to XAI. I don't know if you saw that. You saw that, right?
Look, go ahead. I have views on this.
No, I'm just saying, no, but they don't have the balance sheet people think they do. And doing the robots and all of this stuff, it's a tough thing. At a time when he already took tens of thousands of H100 chips that he basically begged, borrowed, and begged and borrowed from Jensen, who is a master allocator of these chips, and then literally sends it over to Grok at Twitter and XAI because he says we didn't have the warehouses to put these chips in at Tesla.
Two comments. And then one, of course, he got NVIDIA's Jensen to give the promotional ad for Tesla saying that Tesla is a leader in automotive. If you look closely at that clip, you can see Jensen twitch a little bit. But because NVIDIA is building out their own automotive AI capability, which will enable competitors of Tesla because they're picks and shovels place. Second, look, he bought Twitter for $40 billion at the top of the market. He's contractually bound to consummate that deal. He tried to get out of the deal. Morgan Stanley did the debt financing. The debt's trading below par value. By the way, debt's senior to equity. So if the debt's trading below par value, you can sure as hell bet that the equity is at a deep discount to his initial purchase price. And of course, they lost ad revenue on top of that. Now, he did a fantastic job cutting costs, consolidating engineer. And that was really heroic effort. And I credit the leadership on that, to be fair. However, XAI comes out of nowhere because they need capital, right? And Twitter can't finance that. He can't put more money into this thing he overpaid. It's like you buy a building in New York City at the top of the market. You have these cost overruns. You're not going to put more money into this thing. So he has this JV with XAI that he can raise money into. He raised billions of dollars. I saw that deal. We passed. Very expensive valuation, pre-product market fit, pre-revenue, and they need a bunch of NVIDIA GPUs. So what happens? Tesla shareholders are literally going to be potentially put with the bill with this. Like, how do you pass the hat around? In Japan, as you had these Keiretsu type constellations of companies that help each other out. They're really like a failed model. In fact, now Japan has good corporate reform and clarity of governance and accountability. So yeah, look, I think he's in a bad position. By the way, I also read that he's contemplating building these GPUs to be competitive with NVIDIA. Did you hear about that?
Totally. It's the Dojo chips. No, it's again, because he's Tesla, because he's SpaceX, because he's got all of these fingers and all these pies, he can get engineering attention and partner attention to design these things, etc. But to get them made at scale, especially all the way to at the TSMC level or at the Broadcom level, etc. And these are huge tasks. And then the other thing, as I just say, it's relatively straightforward when you say you're going to do all of this in the context of robotaxis and driving. That is a defined problem and an opportunity set in terms of making cars go without steering wheels over time in the context of the roads. But when you start to put it on robots and then you put it on in the context of XAI and Grok, and you're going up directly against the OpenAIs and the Anthropics of the world in the processors. And by the way, and Google, which we are going to talk about, Google has a substantial advantage with their TPUs and their direct relationship with TSMC. And Tesla is number 5 to 10 on that list. You just saw that they just did not consummate their data center, AI data center contract with Oracle, which is the number 4 cloud provider. And they pulled out of that, and they're going to do their own thing in Tennessee, as an example. We're going into the weeds here, but what I'm saying is there are so many moving parts here that have to be operated at scale. And to do this in the context of Elon, hats off to him. He's trying to run Tesla, then he's trying to do the thing at Twitter, X Twitter, then he's trying to do XAI. and compete with every LLM company on the planet. And he's doing SpaceX, and he's doing the awesome job with Starlink. I will give him a lot of kudos on the Starlink side of it. The satellites that have been launched, the mini dish, etc., technically just brilliant. And also give hats off to SpaceX in terms of 300 plus commercial launches and so on. No question that is awesome accomplishment. But on these other things where the promises are so ahead and the edge cases are so massive, because in AI, the issue is it's not even an 80-20 rule. It's typically the last 2 or 3% of the application set, whether it's humanoid robots or driving or AI models, the last 2 or 3% of the application is the toughest to get reliable for the 80% of the actual mainstream use cases. And that's been the killer in terms of self-driving cars, why it's taken over almost 2 decades to even get to level 2 on the level 1 to 5 driving scales. And we are just at the beginning of the beginning on all of these things on foundation robotics or LLM AI robotics, LLM AI models.
There's good news and bad news in that. Look, we still, as you said, I agree, early and in the beginning. We got 8 to 10 years to go on this GPU trend, and that's going to benefit the CapEx receivers. But the idea of Tesla compete with NVIDIA is just absurd on its face. And you and I both know NVIDIA's already pre-funded TSMC. They pre-funded their suppliers. They've locked down capacity.
And don't forget Apple.
Elon, the priority customers. So what's he going to do? Work with Global Foundries or Samsung to get an inferior offering that's out the door later when Samsung's got a union strike? So it's and Intel chips are behind the curve. So a stock is a combination of a story and fundamentals and ideally some momentum. Now, Elon is an incredible marketer, and he's done an incredible amount of accomplishment for human civilization. Congratulations. I don't take anything away from that. But he's in war, there's this concept of the culmination point where when you overextend yourself, you're actually at a moment of peak vulnerability. And I think he's overextended substantially. Focus is excellence. We'll talk about Meta after Meta's earnings, but Zuck is dialed in. Zuck is focused. And I think now they're just selling the future against yet another story. By the way, the other thing, interesting exchange with a former Tesla executive last night. And he said, hey, look, it's hard to get the inflection points on this. If you believe that they're going to win on automation, just own it. So I don't think it's the wrong view because you can measure the inflection, and you're going to measure the inflection in the supply chain, right? Taiwan Semiconductor reported last week, and they said industrial and automotive demand is down and weak. Look at ON Semiconductor stock. Look at APTV stock. So you're going to see earnings calls indicate that there's demand before you see a turn. We're not there yet. So why do you want to own this when you have an opportunity cost of capital and you can bet on the infrastructure layer and people still need these NVIDIA chips?
No, you're totally right. And again, all of this is fine as if we were just talking about mainstream meme stock kind of trading and so on. But the issue that I'm just always startled by with in this analysis and discussion is that the institutional research seems to not go into these kinds of details and put $500 billion, $2 trillion to these things. And more importantly, timelines that basically hint that it'll happen in the next 2 or 3 low single digit years, as opposed to high double digit years.
Look, I'd love to get your take on this. So look, they're conflicted. Morgan Stanley is one of the world's leading tech M&A bankers, along with Goldman Sachs, where you were a partner. Morgan Stanley had a buy rating on Tesla of $400 a share last summer. It was nonsense. We called it out as nonsense then. They're conflicted. Morgan Stanley does the debt underwriting for Elon Musk. Morgan Stanley is doing the debt financing for Brad Jacobs' deal QXO. I'm so grateful to be an investor in that, alongside the Walton family and Sequoia Heritage and Duke University at $9.14. Morgan Stanley's in the debt financing for that. I'm going to make a prediction now that you're going to see a buy rating from Morgan Stanley sell-side equity research. That's part of the package. Now, there's a firewall, and former SEC chairman Arthur Levitt, one of my equity investors, a dear friend, guy who, bipartisan, longest-serving SEC chair, an incredible human being, Reg FD, and simultaneously, he really took efforts to clean this up. But those conflicts persist, and that's because ultimately people roll into the same people. There's someone whose job is to make money.
and equity research is going to roll in investment banking, and those paths are going to cross. Or if an executive doesn't like the earnings coverage, they call the CEO, they'll call up James Gorman. And then who doesn't want a bad bonus? So that's the issue. What are your reactions to what I said there and the conflicts?
No, the conflicts are real, even in a post-Reg FD world, especially in a world that is extraordinarily starved for growth around the world. And there are so many pools of capital. Back when we pre-Reg FD, it was a much smaller world. I was looking at the so-called internet bubble chart and so on in 2000, 2001. Max number of people on PCs and internet was maybe 200 million. Today, Meta alone has 2 billion every day knocking around on Instacart and WhatsApp and so on. Apple has over 2.5 billion. And what I'm getting at it is in that world, you don't just need the institutions, you don't need just the institutional buy side and the sell side. People make up their own minds, and there are huge pools of capital that are not just public and private. Sovereigns are into it. Everyone's into the stuff, and everyone wants to believe in the future. For instance, currently, just as a slight sideways, since we're talking about AI, the current thing in fashion is sovereign AIs. Every country in the world wants their own AI model, which when you think about it, really think about it, it doesn't make sense. Because it makes sense to have a country have a utility grid or a telephone grid, but AI is extraordinarily fungible in a world where we're probably going to go not from 2 or 3 LLM models or frontier models, but thousands and tens of thousands and hundreds of thousands and billions of models. It makes no sense for frontier AI models.
I'd say,
sorry, go ahead.
I'd say briefly, look, sovereigns have an interest in developing AI because it's an arbiter of truth. If you go to China,
yes and no. No. Yes, I didn't mean to interrupt. Please finish your thought.
You get my critique, right? China wants to control truth. No. Saudi Arabia wants to control truth. Every country has got their own version of truth.
I just did a post on the China being between rock and a hard place. Everyone talks about China is on the receiving end of all these US curbs on AI technology and chip technology and so on. But the real issue for AI for China is that fundamentally the way AI works is it totally requires open data, really a lot of data from everywhere that is not edited and censored and so on. And that is not what China has. And the models that are being trained, especially the sovereign AI models in China, there are dozens of them by state universities and companies and so on. And then there are private models. But they have the Wall Street Journal did a great piece, which I have in my post, a link to it. Everyone should read that. And it literally talks about the very arduous process to get your data cleared through this stuff that actually goes into the training, which takes 1 or 2 years and hundreds of millions of dollars before you get a model that people can then bang away and ask questions on. And my point is, regardless, even if there was no shortage of AI chips, China's AI was not going to be equal to the US AI. This is not analogous to the internet, where China created their own internet with the Great Firewall and literally created a thing that 600 and now 1 billion people can be on the internet. That is censored to a point in the context of the data. But if you don't have the ever-flowing set of data that's coming in that's really open, you don't have a good AI.
Let's say it's a good point. It's a good point. Look, you need to train on the Library of Congress. You need to train on YouTube. You need to train on Meta Chat. They'll have aspects of this. Obviously, Tencent has got similar kind of training data. But yeah, if you censor, you limit the value. And the question is, what's the impact and value you can generate without that incremental data that you're going to have in the West?
This is more an assertion on my part, and I'm uncomfortable with the assertions because it's not as quantitative as I'd like. But it's where I get my conviction on this is that the way these models work bottom up in terms of the quadrillions of computations a second on just all kinds of data where it's running all these probability tables. If you're constantly putting censored data into this stuff, the results many years from now are going to be utterly shredded. They're not going to be good enough results for a whole bunch of applications. And that is one of the core issues. When you said, and this is one of the issues I have with sovereign AIs, because when you said there is a universal truth, yes, there is absolutely universal truth in terms of scientific data, etc. But most other things that AI is going to apply to are opinions, judgments, probability curves. Should I part my hair on the left or the right? And what I'm getting at is that you need a relatively free market for the AIs to build their
No, I agree.
probabilities around
This is it's an optimistic take on humanity and the value of an open society and freedom. And
I'm trying to stay away from the optimism, other than I'm going to the way that technically the things works, and the thing is not going to do what it should do if you don't give it that. It is GIGO. It is garbage in, garbage out.
Right.
In this thing more than almost anything else that you can think of. And that's why. And then the last thing I'll just say is that the reality is the world over the last century or so is an English-speaking world. And we don't think about this that much. Yes, there are lots of languages. India has dozens, if not hundreds of languages, and languages are wonderful. It's just that when you're talking about the data that our systems are consuming to train, most of that is in English. And so there are huge efforts going on right now, not just sovereign AI, where people are basically taking the training sets of English models and then using it to generate local language versions of those, and then use that for training and then turn it back into French or Hindi or whatever, and to use it to train their sovereign AI models. And the reason I'm going down this rabbit hole is this becomes very applicable, because that is the stuff that is going to feed whether you're running robots, whether you're running cars. It runs it into all of these worlds. And so it's the substrate on which everything is going to be built.
The truth police and the censorship oriented world is going to be behind the curve for all those reasons. Let's double back to Tesla.
I just want to point out, one last thing on the sovereign AI. Short term, it's a great real business. It booked $10 billion in sovereign AI sales. So that's nothing to sneeze at. That's a real business, and Jensen is totally right to be focused on that. And he's going to sell a lot of AI data center equipment to countries around the world for this reason. So it's not phantom ideas.
No, I agree.
On that.
It's strategic. Look, it's going to be part of the defense budget, and no one's talking about that yet, but that's going to be inevitable. So
coming back to Tesla, yes.
So one is, I thought it was notable.
I love this chart.
A material point here. Why don't you the conclusion of this chart?
No, again, there's already a lot. I think it's one of the reasons why the stock is down today tactically, is people had underestimated just how do they want to think about the regulatory credits in terms of how they look at any aspect of this business, even in the context of the margins, the net margins of the business. I think if you take out the regulatory credits, I think it comes down to 15%, which is the lowest in a decade, if I'm not mistaken. I've got to go back and check the numbers. You've probably already put pencil to paper on that.
It's the worst margins in 6 quarters, and that's even with these subsidies from government. And if you want to understand why, there's some debate on, did Elon offer to contribute $45 million a quarter to Trump, and I guess he didn't. And
he backed off of that on Fortune magazine. He said he is not going to be doing that. He did not commit to that. He's changed his mind, or he said he didn't say that.
All right, interesting. I want to dig in more, because I've also read that he never said it and the media got it wrong. I don't know, but we'll dig in. But here's the thing. Of course, if you run a business that's got a $790 billion market cap and you own more of the stock than anyone else, you better make a political contribution to try to ensure you can bolster your revenue, in the same way that the CEO of ByteDance, who's a billionaire, Susquehanna, made a donation to the Trump campaign, and then Trump flips on TikTok. By the way, that cuts both ways. Trump flip-flopped on Bitcoin and crypto. We'll talk about the end. I'm glad that flip happened. So I'm not making a political comment. I'm just trying to show the reality of how the world,
reality of the world,
modern era. You got to be aware of that or not. But the fact that he pulled out is quite interesting. Obviously, he was backing JD Vance, and now Trump is beholden. He's pot committed to JD Vance. So the timing of the commitment, I don't know what it was linked to. Maybe a soft commitment around subsidies or getting JD Vance. So I really don't know. I'm not a political expert at all. I'm just speculating like anyone else here. But I thought that was quite interesting. Last point on Tesla, and we can shift to Google, is I'll share this chart. And the setup to this is the first 2 weeks of July have tremendous bullish seasonality for tech. This year was no different. Played out last year as well. In fact, this year's playing out uncannily similar to last year. I wrote about this online. I said, hey, seasonality. I wrote this on July 5th, right after July 4th. I said the seasonality can run to 1 or 2 weeks, like clockwork to the day. Like markets topped last year, July 16th, happened again this year, really uncanny. And the tell was this aggressive buying of call options. You had people buying record levels of options. I have a tweet earlier, you can take a look for following online, you can see that's what happened. And when you've got excessive call option activity, those calls are likely going to expire, worthless. Citadel is not going to pay out on that. So here you are, and Tesla is down. I think the other market commentary I will make is that I've been discussing this concept of negative momentum rally. A negative momentum rally is a fancy word for a catch-up rally, or like a worst to first rally. It's a little bit more technically accurate to call a negative momentum rally because I'm using the concept of the momentum factor. I think there are still many catch-up trades that will keep going, like small caps. But I do think that the negative momentum rally that impacted Tesla and Apple is now over. So I hope you guys were able to get out of this. My warning signal was this red line over there. It's obviously not doing too well. It's going to settle. Like the better opportunities, follow the money. Look at where Tesla, Microsoft, Apple, and Google and Meta are paying. They're paying to the CapEx receivers. That's NVIDIA and Tesla and the beneficiaries of that supply chain, which include ASML. So let's shift gears now to Google. So Google stock was also down today, but I think one other backdrop I want to share, I've got a screen here. This screen is showing the stock price reaction to earnings. And I've got an x-axis going back to January 20th to July 24th, so a couple of years, and it's showing the one-day median change. This is a rolling average. So what you can see here is the red line is just around zero. And on average, over this time frame, there's positive stock price through earnings. And that's because company management is smart and they guide to beat revenue and earnings. That's how the game is played. And what you're seeing is this earnings season, you're seeing negative stock price reactions. You saw that with Wells Fargo. You saw that with the banks reporting. You saw it with ASML last week. You saw that with TSMC last week. You saw that with Google today. And you saw that with Tesla. And the general point that I want to make here is that it's not about did this company beat revenue and earnings this day. It's not that. It's not idiosyncratic. It's not about did they beat the whisper. That's how the game used to be played. This is a factor-driven market now. My thesis is that this is just where the tide is. Last quarter, when you announce earnings, everything would just lift 10% up. This is the end of that here in the prior reporting period. Now we're on the other side of that. So I want to share that with folks that you don't overread the wrong conclusion when you see a stock is down on earnings. In fact, Google beat revenue, it beat earnings expectations. So what are your thoughts, Michael, on Google earnings?
Almost everything was in the green in terms of relative to expectations. It felt like everything from the cloud business, the core search business, there are no major sudden moves on investments that they're making on CapEx. The one wrinkle was in the YouTube advertising piece where people pointed out that might be an issue. But even there, if you go into the weeds, there were some similar mechanics. You had Amazon on the Prime side, their ad business was also ramping, so there may have been some tactical dents into, I love these ribbon charts, but there may be some elements there on the YouTube side of the equation. To me, YouTube and NVIDIA, the two barbells of where the TV industry is going globally, when you consider this on a high level, with all the consolidation that's going on in the terms of the streamers, the streaming companies paring back on how much they're going to pay for content. Even Apple, I don't know if you caught that, said, hey, we're not going to, maybe Eddie Q, who's in charge of services, apparently had a meeting with all these studio heads and said, hey, maybe we want to get off the gas a little bit, not pay $500 million for the next amazing movie or show, etc. So you have all of that going on. And to me, the Coke and Pepsi on the global video business and streaming and essentially cable industry 2.0 without any geographical limitations are NVIDIA and YouTube. That's it. And so
Yeah,
I don't buy the short-term wrinkle on YouTube this quarter.
I would say, look, I love YouTube as a franchise. It's a great product. I subscribe to YouTube TV, which is an incredible over-the-web experience where you can get the Super Bowl and everything else you need and live recording, DVR-like capability, all that. I think that the issue on YouTube is the rise of short-form content. There's demand for short-form content. That means Instagram, TikTok. YouTube knows that, of course. They've created like a TikTok-like short reels feature. They're doing their best to respond to that. But it's hard when you don't have a purpose-built app for short-form content. TikTok and Instagram are optimized for that. So there's some user experience trade-off there.
To me, you're spot on that. But I view that as short-term, meaning quarter-to-quarter execution issues on that front in terms of how do you build short-term in technically UX-wise in the context of both? How do you incentivize creators on short and long form? Right. And by the way, on that piece of the equation, YouTube has no competition. TikTok is still trying to figure out their compensation of creator piece. They had a fund here and a fund there, and Meta is not doing anything comparable. And they're just hoping Kim Kardashian and all those people just do things on Instagram till the sun comes down. And YouTube actually has a business. I think Neil Mohan is doing some really good stuff on that side of the equation. And creator piece in terms of how do you incentivize creators to do long and short form on a sustainable basis. And then the last point I will point out on YouTube, especially since we were talking about AI and TPUs and Google being the biggest player in terms of scaling AI, et cetera, and how much it costs to do this. And you've already had a world where OpenAI, even Apple and everyone have had been smacked on the hand for scraping YouTube videos. And they said correctly that they did it through third parties that they paid for, and they didn't know the third parties were scraping YouTube videos to train videos. But when you actually look in the details of that, all they scraped in those cases were the transcriptions, the translation piece. The real value for YouTube is really using the video content to train models. And that is barely just starting. And that is the biggest mother load of training data on the whole world that as ever seen. And the only reason the YouTubes of the world have Google hasn't done it at scale is they're still trying to get compute to ramp up the scale that you need to do that.
Next gen AI is going to be built off of YouTube and Meta-like content. And if you want to learn physics, you need that content. You want to learn human psychology, you need that content. If you want niche subject matter expertise, it's going to be that content. So yeah, no, if you want avatars that are human-like and have personalities, you can train on the millions of influencers. So I agree. These are compelling strategic assets that we monetize in the future that are mispriced today. So I agree. And look, YouTube can say, look, they can change their license agreement as they pay, what, $15-16 billion to Apple for primary search. Obviously, the DOJ, FTC are trying to stop that, claiming any competitive behavior. But you can imagine a world where Google flips the script and they say, hey, Baidu, do you want to license our YouTube data? Do you want to pay me $2 billion a year for that? I can absolutely see that happen.
So you and I have talked about this. I think YouTube is the perfect candidate for what you and I have talked about, our self-driven spinouts, right? If Google did with YouTube what SoftBank did with ARM, which is spin out 10%, okay, that thing alone could be worth more than Tesla today, okay? If the story was crafted correctly, if YouTube could then go do a thing like license, not just content coming in, but then training contracts to competing LLM models as a standalone business, much like AWS, YouTube could be as big as Google itself. I'm sorry.
I love your thesis here. I know you mentioned this before. Look what the success of GE did. GE was a lumbering conglomerate giant and almost disappeared in the 2008 crisis. And they've spun off their subsidiaries. And generally, by and large, I haven't looked at all of them, but they've taken off, like GE Aerospace and Defense and the industrials business, because focus is excellence. And that's worked. So they should do this. Microsoft should do this. It would help competition. It would change the Mag 7 dynamic. It would broaden out capital and dynamism in the economy. It would reduce rent seeking. It would reduce these gatekeeping effects. And these are monopolies, and they do engage in anti-competitive practices. And that's why I own them. So I love them as a shareholder.
And it would take huge air out of the regulatory tires around the world.
And it would create shareholder value as well.
And it could create immense shareholder value. So you and I are talking.
We're on the same page on this.
Same page on this. But it's just amazing to me that is not yet started to happen. Anyway,
it's not in the zeitgeist yet. It's not there. It should be. So the other part I thought was really quite compelling. This story I don't think is getting enough attention is Google Cloud. So Google Cloud is a distant third, as in the cloud business, right? There's AWS leadership position run by Amazon. There's Microsoft number 2 with Azure, and then there's Google Cloud. And of course, Microsoft is an enterprise-oriented business. They know how to think about this and service that clientele. AWS won the startup game, and they've got enterprise and government business. They were first in the business. They've got an edge from that. Google, though, what we saw in this quarter was record growth. They're growing at a faster rate than Microsoft and Amazon.
I love that chart. Sorry, go ahead.
Yeah, so I think that's a story that is not well appreciated around Google, and I think with the introduction of their TPUs, they can build on that.
Again, I'm going to go back to the self spin out thing again. The market today has no, and we and I have talked about this before. Market has no public way, really high end way to invest directly into this side of the business. I went and looked, by the way, just the number of not even AI data centers, because Jensen has said, look, over the next decade or so, we're going to need all the data centers in the world to get upgraded to AI quality data centers, which is, it's a buzzword, but it's actually very real. You really need to redo these data centers. And I know data centers. I took the first ones public, like Exodus and Inc. and Eck and so on in the 90s, and Loud Cloud you talked about at the opening of the show. So data centers are close, near and dear to my heart. But right now, if you look at today, Amazon is number one in terms of revenue, right? In terms of cloud data center businesses around the world. Number two is Microsoft Azure. Number three is Google Cloud, and number four is Oracle Cloud. And then you, of course, were very early and into things like CoreWeave and so on. So I know this business pretty well. What I'm getting at is that when you look at Amazon, they talk about data center availability zones. So long story short is they've got 200-300 data centers in that mix. And Microsoft has, based on how physical data centers, a couple of hundred data centers around the world, and they're obviously always trying to scale to AI. And about half of those are dedicated to OpenAI, obviously. And then you've got Google, which has 50, 60, 70 data centers, but most of them are for their own businesses. They've not yet built out the business yet. They're doing very focused. Korean is the CEO is very focused on building it out for businesses. But what I'm getting at here is that this is the perfect opportunity for either Microsoft or more Google to again do a 10% spin out for Google Cloud. That would allow it to really scale relative to AWS. Again, investors would it would be an entirely different kind of opportunity that it would leverage Google's core Gemini assets. Everything they're trying to do, they could speed it up by 2-3 years even. And so, yeah, I'm very excited about Google Cloud, but I worry that it gets covered up in the total Google business.
The same reason I'd love to own Amazon AWS, but I don't want to pay that multiple for Whole Foods. It doesn't make any sense.
Correct.
The other thing I'd say on Google, and one reason why arguably it's down, but I think, again, there's a broader picture around stock price reaction, but is CapEx is going up. This is part of our CapEx receiver thesis. It's called the follow the money thesis. So they are ramping up CapEx and substantially. But the other part worth pointing out in this is that Google's been investing in custom silicon for years now. They've had a contract with Broadcom. So they're actually going to be more capital efficient on that spend versus their competitors who have to react. So they're using NVIDIA chips where they need the NVIDIA chips, which is on the LLM.
The customer-facing, external customer-facing LLM applications.
That's right. And then they use their internal. Correct, for ML and narrower niche use cases. So they're more thoughtful about how they do that. And Ruth Porat, the CFO, she's very disciplined about all this stuff. They obviously had
she's awesome.
She's fantastic. She's world class. What else on Google? They invested $5 billion. Really, of course, Google and Tesla report the same day. It was really funny. So as you shared this on our prior pod, I recommend you all listen to my podcast interview with Michael Parekh a couple months ago. I think it was in May. We talked about Waymo. We go really deep on several of these topics from a longer term perspective. So really here we're doing some kind of incremental updates to that. But they invested in Waymo, which is the level 3 player in the market. Tesla's level 2. Mercedes is up there, I think, level 3 as well. So I thought that was an interesting announcement, although they're
limited.
To your point, they're negative unit economics due to the high cost of LiDAR technology versus the video-based approach Google's taking. Question for you. These LiDAR stocks have been hammered. They're all in the dump. You can't distinguish them from like an EV stock at this point, okay? Or like a SaaS company, okay? So are LiDAR unit economics improving for the buyers? Meaning, are the cost of LiDAR technology dropping since maybe you've got more competition?
Yeah, as the business of producing cars is far more complex than just specific individual components. It's far more complicated than even the PC industry in the 80s and 90s, where for every Dell and Compaq, you had 100, 200 companies basically buying disk drives from Seagate and so on, and then bringing down those price points of those components to build, $1,000, $2,000 PCs. Why do I make that analogy? Because in the context of cars, it's not just 3 or 4 or 6 components, it's hundreds of components to build a car piece. And that's why, yes, you're totally right on the LiDAR component of it. Yeah, today, even Tesla, if they wanted to consider adding LiDAR to their next generation models, Elon probably has a better calculation today than 3, 4, 5 years ago when he said no LiDARs for me, and we'll do it through camera. So yeah, in theory, there is that piece, and that's a good thing. But the reverse problem here is, as we've talked about, it's not just this. In the old days, if you put a component that was expensive and put it in a PC, there was not a variable cost to running those components. In the context of self-driving cars, especially as we go from level 2, level 3 to level 5, the amount of data you're going to have to process and serve back real time, the infrastructure for that is again stratospheric. And this stuff is variable cost economics. When I'm sucking in the sensor data from a million, 2 million, 3 million cars, and then processing it all to do the generative AI stuff, and then spitting the results out to all these cars real time on the variable cost. That's talk about training, inference costs, etc. That we know that's an inference driven business, which is a very high capex kind of business. It's very different than auto businesses of the past. They're very different than PCs in the past. And by the way, it's totally tied. You may have seen the article in the information today about OpenAI's economics, that they're going to, even with $3.5 billion in revenues, they're going to lose $4 or $5 billion. Why? Because variable cost of inference. The more people you have using, it just takes your.
Or they're going to lose money by year end. Obviously, they'll raise money and they'll figure it out and they'll get bailed out. But it's another example of either you're a capex payer or you're a capex receiver. A capex payer means you're spending money on NVIDIA GPUs. You'd rather be the one that's collecting that and the picks and shovels infra player. Yeah, look, that's why the snowflake is out down in the dumps. These were supposed to be capex light SaaS businesses, and suddenly now they have to do $1 billion M&A transactions to, one, become AI relevant, and two, they've got to start spending money on GPU. So I believe that we will continue to see outperformance from semiconductors relative to other tech names, and certainly SaaS. I expect that to continue. I'm going to share my screen now and talk about just positioning within Mag 7. So folks can see my thoughts on NVIDIA, Meta, Google. Now, folks have been following me for a while. They know that in my newsletter since the beginning of the year, you can see it on Twitter, I've said the best positioning for Mag 7 has been NVIDIA, Meta, and Google. So if you've got in the S&P a 32% weight on the Mag 7, I would argue that you can outperform the S&P simply by modulating that weight and owning NVIDIA, Meta, and Google. Let's take a look at that now. So NVIDIA, it's like, first off, who are the winners year to date? I'm going to sort by year to date winners in descending order. The winners are NVIDIA, Meta, and Google. Now, the question is that going to continue? Will that trend continue? It's something I've been asking myself. I think the answer is yes. I think it will continue. And the point here is that it's a barbell, right? NVIDIA is the leader. I don't see that moat going away anytime soon. People needed NVIDIA GPUs yesterday, and now countries need it. You and I talked about NVIDIA in depth previously. Obviously, it's priced when it was since our last podcast, and the weight you might assign to it is different than the weight probably was back then. But if you look at Meta and Google, these are value plays. Meta's got a forward PE of 22. Google's got a forward PE of 21. Compare that to Tesla with a forward PE of 73. I look at Meta and Google and I say, those names are not priced in for AI, and they have the content, and they have the distribution, and they have the engineering know-how with Jan LeCun and the progenitor of the Transformer paper at Google. So I think that barbell approach, NVIDIA for the growth, that value play, Meta and Google, is still a good combination, and Tesla is in a void, 73% forward PE. By the way, it's the most shorted stock in the name in this Mag 7 years. Obviously, you can see the red here. So any initial thoughts on that positioning?
No, I love the positioning. In terms of CapEx spenders and CapEx receivers, the Meta, because they're also the champion of open source, they just released Llama 3.1, $405 billion 405 billion parameter model. Zuckerberg has got that piece. He's figured out how to optimize a piece of the equation where the world is going to build a lot of models and infrastructure that drives to his creators. We were talking about the creator economy on Meta that could really add value to his piece of the model. So I just wanted to highlight, since we talked so much about Google and the other, I just wanted to also give some props to Meta in that equation as well.
I agree. I agree. Let's actually look at the benchmarks on Meta Llama 3. It's an impressive platform, and there's more to come on this. The giant has awoken, right? Zuck pivoted the business, focused on Meta, but here you can see on the screen the Meta Llama 3 benchmarks. You got the 8 billion parameter model, which is going to be more for edge AI and mobile devices. You got the 70 billion parameter model. Now you got this 405 billion parameter model. Also, you got GPT 4.0. So Llama 3.1 outperforms the best closed source platforms like OpenAI on certain benchmarks, not unanimously on all the benchmarks.
No, and it'll be improved. The other thing I would highlight is because they're open source, because they're marketing it aggressively to the Amazons, to the sellers of the cloud services we were talking about, that businesses, and by the way, NVIDIA as well is a huge beneficiary here because their NIMS and NeMo platform can take these models on cloud hosted services. And these, the Llama 3 is really going to be very effective, as has been talked about, not just in terms of direct performance benchmarks like this, but also for actually training and generating synthetic data on a whole host of other applications. I'm going into the weeds here a little bit, but data is one of the core drivers of the AI tech wave, and these big models are a godsend to businesses of every stripe, companies of every stripe, users of every stripe, being able to generate tons of new synthetic data that can drive very customized applications. And that all benefits all the cloud guys that we talked about, the Googles and Amazons of the world.
The CEO of Amazon is now pushing Meta Llama 3. He said, hey, come to AWS. We got Meta Llama 3.1 locked and loaded. You can rent it. It's open source. So really, I think what Zuck did with Meta Llama 3 and making it open source is absolutely brilliant. He penned a paper, I think it was released yesterday.
It's in my post. Yes, it's actually worth reading in its entirety, even though it's a very long paper. I totally recommend that one. Go ahead.
What are the highlights? I'll pull up the paper now. What are some of the conclusions in that missive?
He goes both high and low. He's walking you through the broad opportunity around OpenAI, and then he goes into the weeds of some of the things that we're talking about. That this stuff is not just about competing directly with an OpenAI model or an Anthropic model, but it really is about helping businesses create all kinds of data sets and applications with this Llama 3 as a fundamental engine to make that stuff. It's actually very different than some of the opportunities that his competitors have with their large models. If you go down, there's actually a good summary of some of the key points right there. Yeah. And where he walks through the pluses for the developers and so on. So he lays it out all there. Again, this is as much as to developers in general understand this, but this kind of puts up in neon lights why this stuff is very important. Because you can, if you go back to my 6 layered boxes, the chart that you and I talked about in our last discussion, this basically empowers thousands of companies and actually hundreds of thousands of companies and more to do a lot with this as a raw material to create a whole host of AI products and services that are much. And one of the key reasons, and I'll go into the tech weed here, is it's open source. So a lot of people like buzzword. What does that mean? It means that this one also has good licensing terms, and it has access to the weights, so that when you're building your own models and data, you can tweak this stuff a lot better than any of using OpenAI's model, because you don't have access to the weights that go into the training of those models. It's a bit of a techie in the weed stuff, but the way he writes it out, it helps explain why that's important.
It's a big deal, even like for humanity. Zuck's done a big 180, I think, and it's good imagery rehabilitation for him, especially when he had APIs he could do stuff with on Meta. Then there's a rug pull on that. He shut down the APIs, but it's an open source intelligence, and they have a real shot at being the best in the world for all the reasons we've discussed: their content, their training, the access to the GPUs. The risk from a stock perspective is that they've spent a boatload of money of CapEx on this. Like Google will be more cost efficient because of their custom silicon. They've been ahead of the curve on this. Duck's approach is, give me GPU, Jensen, send the GPUs over here. We want them now.
Yeah.
So that's the one risk. I think it's a good investment to make, but companies that have heightened CapEx on average underperform.
Yeah.
So that's a kind of a statistical phenomenon, something to consider there. Yeah.
The one thing I'll just say on that issue, that about the gimme GPUs, yes, he wants as many GPUs as everybody else, and he's front of the line along with Microsoft and to Jensen, for instance, on that piece and everybody else. But the one thing I'll say is that when he says, give me the GPUs, he needs that for the training and the inference on his services, his Facebook, WhatsApp. And a lot of the inference on that stuff is, as you and I have talked about, will actually over time, very quickly over the next 3 or 4 years, especially as Apple and the Android ecosystem sells more phones that have much beefier AI and neural engine chips, a lot of that inference will run here. What I'm getting at is Meta is going to need relatively fewer GPUs than most of his competitors by the nature of the business. It's a subtle point, but yes, he needs them right now, but it's on a relative basis. His CapEx budget on that piece is a little bit lower. And remember, this is a company that's already still spending gazillions on metaverse and so on, and he's throwing out huge cash flow and so on. So he's got a lot of room to adjust the levers in terms of give me the GPUs side of the equation. But relative to one of the companies you were talking about earlier, Tesla, which his balance sheet restricted on give me the compute piece of it.
So much free cash flow, and so does Google, that they can fund the CapEx investment. So although I love the CapEx receiver thesis, but I believe that these names aren't priced for AI. And then when they ultimately are priced for AI, namely winning the prize around personal assistant AI, which is the holy grail.
Correct.
Took a few years to get there. When they get there, then AI is ubiquitous. You're entrenched. It's convenient. It's omnipresent, omniscient. So that is killer.
And that's something, and that's an important development to highlight since our last discussion, because back then, so one of the things that's happened in the last 3 or 4 weeks, and I've done several posts on this, is that both Open and Google have leaked their path to AGI, artificial general intelligence, and they brought it down to earth, is the way I phrased it. And they're basically now saying, look, there are 5 levels, just like the car side of the equation that we were talking about it. And OpenAI is we're at level 1 with chatbots. The next one is going to be AI reasoning, and then AI agents, which are level 2 and 3. And then these systems are going to be ability to be innovators and then and to run entire organizations. That's like self-driving, full self-driving. And that's years away. But the core piece, what you said, reasoning and agentic work on top of chatbots is the core thing over the next 2 to 3 years, which everyone is focused on. Microsoft is focused on. OpenAI obviously is now going to, and Google came out with their own version of that level 5, which I wrote about. They put out a paper that outlines their pathway, which is similar. And so what I'm getting at is the reasoning and agentic stuff is going to be a place where, because the Metas of the world, the Googles of the world, the Apples of the world, the Microsoft of the world are touching every day applications and services that billions of people use every day. That's where the reasoning and agentic stuff comes along. And by the way, as you ramp up applications that reason better and do more agentic work, your compute again goes up. So give me the GPUs goes up again, to your point, to the CapEx piece of it. So
future. Yeah, I know Jensen has a 4 to 5 year timeline on AGI. I'm actually there as well. I'm at the 4-year mark. Obviously, one could debate the definition of AGI, but the disruptive potential is extraordinary. And one of the reasons why I'm not going to buy Expedia stock or Booking stock is that Google will have a travel agent and that industry goes away. That's not priced in, by the way. That's not priced in.
You're right. And the Bookings of the world, again, need to figure, they have fought a battle for the last, and they have been fighting a battle with the airlines and the hotels directly, fighting with them to get the consumer to come to their site versus go to the airlines and hotels directly. But in the world you're talking about, the Googles and the Apples and the Metas of the world can essentially be the front end for the bookings of the world. So that's not a well thought through thesis.
I agree.
So,
there's a lot
important.
of disruption that's going to happen.
Correct.
Not just legacy business models or legacy business
Correct.
now are now internet businesses. Tech is disrupting tech. You have AI disrupting SaaS. You have AI disrupting companies' birth in the .com and the aftermath of the .com era. So the velocity of disruption and the how you position within QQQ matters. This is why I don't like owning indices. Most people should just own an index, do direct indexing, go to sleep well at night and let it compound. But if you can spot the disruption, why wouldn't I get out of harm's way and bet on what I believe folks have a competitive advantage?
That's the alpha route, no question. Active management.
That's right. So we covered good amount of ground there. What are some of the questions we have from the audience? Crypto, digital assets. I got a question there.
Good.
Michael, any observations and thoughts? Just to frame it up, you've got Trump has really embraced digital assets, Bitcoin and crypto. Started with Ryan Selkis from Asari at Mar-a-Lago, and he gave a spontaneous speech. And then he met these Bitcoin miner CEOs. Then he took in a flood of donations. Now JD Vance, he owns Bitcoin, and he's also on the banking committee, so he can influence and shape regulation. He understands that, and he's a lawyer, so he really understands this stuff. The tides have turned from where we were just a year and a half ago, and now there's some speculation that candidate Harris may be speaking at this Bitcoin conference. What are your comments, reaction, thoughts on crypto, digital assets, policy, etc.?
No, look, obviously in an election year and all the cross currents that you're talking about in terms of Trump having flipped on crypto, he barely understands, I'm sure. And JD Vance now on the piece and so on. And then also the shifts the very visible shifts that people like Andreessen Horowitz made of late on the crypto side. And if you look at all their Twitter accounts, they all have the red eye pieces and their logos, etc. So yeah, this is a political football through November. And the crypto conferences are going to have a little bit of a tailwind in terms of the candidates, both on the Trump side and also with on the Harris side now trying to attend. And so that is a regulatory perceived tailwind for now on the crypto side of the equation.
That's right. Look, I think Solana ETFs are going to come to the fore. That'll be the next topic. Obviously, the Ethereum ETF launched today. There's some, or yesterday, and throughout this week, there's outflows from the closed-end funds from Grayscale. They're up 2.18% today on a day. Stocks and really all stocks are down. Bitcoin is up. I think they call that diversification. It's happening yet again today. By the way, when that phenomenon happens, it's generally bullish for digital assets when that time frame, when that pattern occurs. We have another question. Can you please tell me when U.S. tech buying happened after the big sell-off in tech today? Crystal ball question. I had some discussion around this last week. I would say, like, one, if this plays out like last year, then you're going to have some kind of correction. That's one pathway. Clearly, we're seeing negative stock price reactions going into earnings, which we talked about earlier on the show. I think that'll continue to happen. You wait for that to stop happening. That's what you do. You don't try to predict when it stops. You measure when it stops happening. And it will at some point stop happening. It happened last quarter too. These things can flip at some point. Obviously, we're going to learn a lot from Meta and Apple reporting very soon. And the way we played Meta is when we don't know how these companies are we don't know the reaction. We don't know the reaction. That's the key thing. I think folks are positioned long, and that positioning, and remember, those long calls is causing these negative stock price reactions. So if Meta were to tank on earnings, I'm not saying it will, but in that case, I would go buy it. It was a gift. Last quarter, we bought it when it tanked. I said that's how we would play it. We did. And then we titrated down as it rallied. We brought it back to a normal weight. I'm a slight overweight against my benchmark position in Meta, meaning my goal is to beat the S&P. So I look at the weight of Meta within the S&P. For sure, I want to have my benchmark weight. I want to be aggressive on my weight when I think it's cheap. I have a slight overweight to it now. Part of this, by the way, I think there's value in other parts of the market also. And all these assets compete with each other for capital. I think semiconductors are getting interesting again. We talked about ASML last week. And if I look at like Micron and Qualcomm and some of these names,
you had a good call on Qualcomm.
Yeah, you and I had a good call on Qualcomm. Actually, when I interviewed you about Qualcomm back in May, the thing just started ramping right after that. I think people woke up to the Qualcomm. But if you look at like where ASML is, you get some support per day moving average. By the way, when we had our buy call on Twitter, October 9th, that was like in the depth of this correction. No one knew when it was going to end. October 26th was the bottom, but we said, hey, going into earnings season, that'd be long. Don't try to perfectly. And then the Iris Zone conference wasn't quite the top. March 8th was the top for risk assets in general, but Iris Zone was like this. it was like a sell the new learned about ASML nowhere since. But now you're back to levels that are interesting. I'm not saying buy it here, but I'm starting to lean forward and say, look, I find value there as compared to other tech names. So ASML used to be more expensive than NVIDIA at a 4P higher than NVIDIA during the Iris Zone conference. Now it's 33. And if you look at other names in the category, I don't think Qualcomm's priced in for the Snapdragon, Apple AI, Windows chips that are going to come. I think Qualcomm is going to be quite interesting as well. It's cheap to 17.4 Ford PE. I think Micron is quite interesting. Bottom picking is challenging and hard right now. I think we are in a correction. It's a summer correction playing out very much like we had last year. When you start to see buying, that's a sign that you're experiencing some kind of panic. We don't have that yet. We have like record call buying that we're working off. So that's one. The second thing is that this is a very sharp correction. It's fast and furious, unlike last summer, which played out over 3 months. The sharper they are, the faster they can reset. And people are still underpositioned. People are still offsides. There's still a lot of people in cash. I talk to folks regularly in the market when they knock on our door and I see their statements and portfolios. And a lot of people just missed out in this market. And there is a secular earnings growth story to semiconductors. The earnings revisions will be manifested with, I think, the delivery in the actuals. The problem is that you're getting negative reactions against that. So this is mostly positioning and psychology driven in my mind. And then, of course, you had Trump's comment last Wednesday around, hey, maybe Taiwan can protect themselves or at the very least defend themselves and pay up for us. So that was the day when you saw these names start to decline. But I don't think that was the approximate cause. I think like anything would have popped this thing.
No, but on that side, that was the day, but that was also the day that the Biden administration said, hey, we're going to do more curbs and so on. And so that back and forth, that was another element that spooked the semis. And on the flip side, I took comfort a little bit from, I don't know if you saw NVIDIA's announcement, that they're tactically building a whole set of not just chips this time, but data centers for China. And that's 10-15% of their business historically. And so this back and forth is going to go on. And these new chips and new data centers, they've, I'm sure, worked through with the Department of Commerce to make sure that they pass the smell test to be sold to China. I talk a lot about in my various posts about US-China, very important to, quote, thread the needle on these geopolitical issues. And it's a huge important thing for semiconductors. And so anytime we see the tailwind get a little bit of an opportunity to be optimistic, these things are going to obviously see some reaction.
I agree. NVIDIA is optimizing for China. They comply with the law, and then Department of Commerce Secretary Gina Raimondi chastises them for shipping anyway, but they comply with law. So what do you do?
And in the meantime, Google and Microsoft, since we were talking about the cloud business, the regulations say nothing about Chinese companies who are all offshoring to Singapore and Malaysia and all these places, and they can rent as much cloud compute, the chips, even the Blackwell, through the Googles and the Amazons and the Microsofts of the world around the world.
Yeah.
So there are relatively fewer curbs on that side of the equation. So it's a cat and mouse game.
No, I agree. We're going to briefly on NVIDIA. Look, I do expect NVIDIA will outperform on a relative strength basis. That's certainly playing out now. It played out in April 24th when the correction was. Look at this. NVIDIA bottomed April 24th, whereas Semiconductor did not or went back to their moving averages. So I do think you're going to see relative strength there as well. So look at that. QQQ came much closer.
But again, if you look at it on a broader macro basis, this Sunday, which was the big earthquake in terms of Biden stepping down, etc., this Sunday also, all the major publications called it, was literally the hottest day ever recorded for the planet. So what I'm getting at is that these are, yeah, we have to think about this short term, and the data center stuff we're talking about. That is one of the biggest challenges for the Microsofts and the Googles and the Apples, not just for PR perspective, but they are trying to do carbon neutral build out of the data centers, which is increasingly tough. And one of the things is even all the oil companies are totally cognizant of this, and they're optimizing for these realities. Sorry.
I agree. No, I like SMCI too. Look, if CoreWeave's building out 28 data centers and Google and all the hyperscalers they need to buy racks and machines loaded with GPUs. That's how you actually buy the NVIDIA chips, by the way. Like you can get NVIDIA directly, or you get clusters, right? And they're going to buy from Dell or they're going to buy from SMCI. SMCI is a pure play. You can see that 200-day moving average coming up for support right there. And 22 PE, I think that's quite interesting because it's cheaper than ASML, NVIDIA, Taiwan Semiconductor, and all the other names. They also make margin, unlike Dell, which is a more diversified bet. I think those are interesting ideas. The way to approach this, I would say, is like partial positions. You have to titrate based on the risk reward in the market. When you see a capitulation, you can see it in hindsight, but you don't know that you're going to get one in advance. That's the issue with markets. So it's okay. If you see these volume spikes and these call ratio spike and sentiments washed out, that's not the case. None of those factors are in play right now.
No.
Then you can be aggressive. But now these are partial positions. It's almost like you're playing a game of poker. There's value on the table there, but you're dealt like a jack and like a 5. And you got 4 people playing. But you want to stay in the game. You're going to bet some. You're not going to pull your chips on the table there. So the tension is between small caps, semiconductors, and even other names. Remember this whole breadth expansion. There's a question that came up around thoughts on oil. I'll share my quick take. Look, in a Trump presidency, what happened is you'd have more drilling, you'd have restrictions relaxed in natural gas. Shineri LNG, which is a name we've written about, it's done well. I think it would benefit because they can export more, right? You need permits to be approved by the Department of Commerce to export LNG. You get more M&A activity too. So those are some mixed effects there, right? Like the energy companies do more M&A, technology do more M&A, a lot of M&A across the board, right? But I think it's short-term, long-term. But you probably would see more oil production. You would probably see more liquid natural gas production. So commodity prices could actually come down. And so then it depends on where is that company in the value chain. If they're a driller and their earnings are linked directly to the price of oil, you have a price versus volume trade-off. Price goes down, but volume goes up. So what's the net impact on profitability? That's one question. If you're a refiner, you have somewhat less exposure. It's more of a volume game, but you still have exposure. If you're energy services, I think you're good. We love energy services because you have the least exposure. Energy services, you might be like a tanker business. You're moving more oil around. You rent the tanker, you fill it up with oil. Okay, you're not sensitive to the price of oil directly. So there are different ways to play that. Hopefully that helps. Michael, any thoughts on what oil or energy outlook would be in a Trump regime?
Yeah, you I think summarized it well. Obviously, a lot of the restrictions that we were talking about would get lifted on that side of the equation. Presumably, also it's a little bit more headroom on the data center and energy discussions that are going on in the Middle East with Saudi Arabia and the UAE, etc. You saw Amazon just signed a $5 billion contract in the MENA region, especially with Saudi Arabia. And all of that gets a lot more oxygen, as it were, under a Trump government than not. Because right now, the Biden administration has been trying to thread the needle in terms of national security and some of those other countervailing issues.
I agree. I think one other curveball in all of this is candidate Harris. Trump's been leading the poll, swing states, betting markets, wherever one. There's a Trump bump phenomenon. We wrote about this back in February. We can see it when Trump won the Iowa straw poll, China tanks. When Trump won the debate, energy stocks went up the next day. So that's in play. Now, what's going to happen is a DNC convention is going to come up and they'll have a chance to create focus and attention. Trump has this news cycle around him, which reinforces his messaging. It's incredible, right? Whether it's courts and whatever else, it doesn't matter. Like it just reinforces the messaging. And when Biden gave a speech, like I think it was last Monday or Sunday, no one really paid attention. It's ignored. So this dynamic with the DNC is going to change focus and attention and just scramble things. If there's a Trump bump and Trump was peaked for max probability win, you can't get more max than max. So that's going to mean revert. I think candidate Harris is 37% on poly market. I think that actually goes up. I think, and this happens almost every cycle, after the RNC convention, the polls for the candidate are max, and after the DNC convention, then the polls for the DNC candidate are maxed out. That's going to happen here, and that's going to cause some deflation for the Trump bump. However, we are seeing breadth expansion. So you have these countervailing forces, right? I do think the breadth expansion is real if you've got Fed rate cuts in sight, and if the economy is not fundamentally slowing down, if it's not going to go in a recession, it is slowing down. It's renormalizing from a 6% nominal GDP hypergrowth that we saw last year. That's my view. There's some countervailing forces and tensions at work there. But on balance, though, look, we had a wicked rally. Put call ratios were just offsides. Trump bump maximized. You had negative stock price reactions, and we were ahead of earnings expectations. On balance, I do think that sets up for a correction, and I think that's what's happening now. The question is the whole "are we there yet" analysis.
No, so what we're saying is wait for the earnings season to go through, and then probably wait through for the election cycle to go through. And my just high level right now, for a whole bunch of reasons that we talked about, but in terms of big tech and regulatory stuff, as I just look at it, AI driven stuff, in terms of what's ahead of us over the next 2 or 3 years, the companies we've talked about, the big tech, and by the way, also it's as good for the little tech that Andreessen and company talk about, right? This is actually very good for the little tech side of the equation as well, where the US remains the best regulatory environment under either administration relative to Europe and relative to China. For all the stuff we talked about China on the AI side of the equation, Europe has its own sets of issues. I've written about this in terms of the EU really focusing on the big tech companies and so on. And some of the US companies like Meta and Apple are all but saying, hey, maybe we won't even bring some of our AI products and services to the EU. Because on the penalty side, the EU is threatening to take 10% of the global revenues of these companies, which ironically is bigger than the actual European component businesses for an Apple or a Meta. And so regulatory-wise, regardless of which administration, the US remains the most positive market for both big tech and small tech. Yes, on the big tech side, under the Biden administration, you've had this regulatory force with on the antitrust side of the equation. Who knows how that changes with either a Trump administration, presumably not as focused on the antitrust side, and potentially somewhere in the middle with a Harris administration. Those are variables that to be thoughtful about. But in general, on a macro basis, the U.S. remains the best, independent of the political election cycles, a relatively best area from a regulatory point of view, especially when you look at it from the AI lens.
Yeah, said. I think on a day like today, it's good to see who performs, who's got a relative strength. I want to share my screen and I'll show you the members of the NASDAQ, because if someone's performing today, that means you got institutions buying. And if you look at the NASDAQ 100, obviously the biggest loser there is Tesla, the Trade Desk, SMCI. Trade Desk, quite expensive stock, by the way. There's NVIDIA, that's Broadcom, Semiconductor in general, Qualcomm, Marvel. Like the best bid stocks year to date. Best in the rest, AI theme, the number one theme of the entire year is correcting right now, right? The momentum factor is rolling over. That explains part of that, right? Google, ASML, these are wonderful businesses, right? So those guys are correcting. Lam Research, some SaaS on semiconductor, CrowdStrike, going down again, extraordinary. Then you see the winners. These are things people don't really talk about. It's notable to see that, right? So I think you are seeing catch-up plays, but not this negative momentum rally like Apple and Tesla. We had Sciences. By the way, look at Pfizer. That's basing. I don't own either, but it's just an observation I'm making. These names that are starting to get inflows, there's this craft that's consumer staple, energy name, Cisco. These aren't popular names. AstraZeneca, ISRG. Look at the S&P 500. You've got some overlap there on the loser. Again, the hottest stocks, your Constellation Energy getting whacked, Broadcom, right? And then on the leaders, you've got AT&T. Okay, solar play, Seagate. These are very unusual names, kind of defense play. General Mills, consumer staple, healthcare. Definitely some defensives. That's definitely one pattern that you see within there. Small caps, even though every index players that are doing well there. Here's Innova. I talked about Innova. They reported earnings, so get up on earnings. You've got LPLA. Bought LPLA last week and maybe earlier this week too. I believe they are up today also 3.8%. This thing hit 5-year lows and on some news, but not all of them. I picked up that one's down today. I don't know. My view is that this is bottoming. The issue with names like this also though is like 5-year lows. It's same growth rate as it had, except it's 3 times the earnings, 3 times the cash flow in the cap. So I like that. But one of the issues that's going to happen is this. The cheaper semiconductors you get, the more appealing they are relative to the rest of the market. So that's what created this dynamic when NVIDIA reported earnings May 26th, the rest of the market corrected because the earnings were so strong. Mm-hmm. People said, why do I own everything else? I'm going to sell that, buy NVIDIA. The market was down. And then there was this major breadth contraction. People just rolled into NVIDIA, re-rated NVIDIA from a 33, 34 forward P to 43, 44. So I think this tension of small caps and semiconductors is playing out. I think GLP-1s are fully priced now. I don't think it's worth spending time around that. I think you have names like Chipotle and all these things fully priced and go away. But time horizon matters. What's your positioning versus your benchmark? I think semis will do fine like a year from now. I think they'll do quite well. Nailing the timing exactly is difficult. It takes skill. You got to be patient. The best antidote is have many good ideas. So you're not attached to any one idea, and calibrate what your semiconductor weight, what you want that to be, what percentage of that of your portfolio. And as it gets cheaper, you can titrate up. But I would say, yeah, let's get through earnings season and look at last year. I think it's sentiment's extended, right? AI bull bear ratio. I posted that on Twitter today. It's ahead of itself. We talked about put call ratio. But you're going to get a good buying opportunity. So if you miss the rally, you should be happy. You should be thankful. Warren Buffett says when prices drop, he gets excited. If you have cash, build it up. Get that cash position built up because you're going to get another shot on goal soon. And the move to make would be to buy the best, buy the leaders. When you have a correction, buy the leaders and upgrade. If you have weaker names, sell those, tax loss harvest, whatever you do, and then upgrade to the leaders. That's the move to make in the weeks and months ahead. I suppose we can call that a wrap. Michael, how do folks follow you and learn more about your research?
I write about AI every day. Thank you for that opportunity. The URL on the screen, my Substack. I write daily missives on AI and tech and so on. And then my Twitter feed, Parekh at Parekh. And so those would be I do have some of the stuff on YouTube as well. Parekh.
Thank you, Michael. We'll have to do it again. We have more tech earnings coming up. That'll be great. We can perhaps chat then as well. You can follow the show on Spotify, YouTube, Apple Podcasts. We do cuts on TikTok and Instagram. We also have a channel called @LumidaWealth on Twitter where we do curations. Check that out. And also, if you're listening, go ahead, Michael. Yeah.
I would highly recommend following the Lumida video clips. I don't think anyone does as good a job as you guys on curating great clips on all kinds of matters, not just tech and so on, where you do the work of going through 1 or 2 hour podcasts and so on, and then summarize them. I think they're brilliant. So I just wanted to a shout out on that. No, it's just
part of my cheat code. It's like, how do you stay on top of things? So we have people that alpha is trapped in podcasts. It just takes one insight to make a difference. So the cost of not having that is high. So by the way, if you all see a great podcast, we just summarize, let us know. We've done this for, I think, On the Margin, Bloomberg Wall Street Week, Build Early, BG. If Lex has a good interview, we'll do that. Your shows, we'll find where the insight is and cut it up. And then the other thing we're doing, by the way, if you go to Lumida.com, we've never promoted this or announced it. I've been quietly building in public here. But it's quietly getting traction, actually, getting like thousands of views a day. If you go to Lumida.com, And this is AI powered, by the way. It's super cool. I'm going to share my screen real quick. We track different investment themes from AI to uranium to semiconductors to markets to macro to digital assets to commercial real estate. This is all the content that I value. And I said, look, if I value it, then other people value it. So I'm eating my own cookie there.
No, this is a great resource, and it's very useful.
Yeah, it's like Drudge Report for investors, but the value of it is we are pouring through like the Wall Street Journal, Financial Times, American Banker, CoinDesk, Real Vision, and adding more and more. And it's organized, and there's a filter. There's a human being that's saying, does this add value or not? So there's some curation.
And the one thing I will add, as much as I'm a fan of AI long term, to do this kind of curation, AI can't touch this, to quote MC Hammer, for at least 3, 4, 5 years. So this is all for people who are interested in these topics. I would again do a shout out here and say, well, you guys are doing good work here.
Thank you so much. Yeah. Lumina.com is super, super cool. First time I've ever talked about it, actually. And then, by the way, here's another one. It's a project called Lumina ETF. So take a look at that. If people sign up for this, we get to a certain level, then I'm going to launch this thing. But I'm taking like Dollar Shave Club approach, get a wait list going. I'm very excited about the opportunity here because this is a market where you got to be more active. I think there's value if you can be more active, right? When you see Cathie Wood buy AMD, that's like the NVIDIA top. But if you sell, you pay taxes. So, well, what are you going to do? You just eat it. Or if you see Dell ramp 100% in 4 months, it went from cheap, undervalued, ignored to consensus and overpriced. You're supposed to sell, but if you sell, you pay taxes, at least if you're a US taxable investor, right? So in an ETF, the IRS does not view in-kind transactions as taxable. So what an ETF can do is it can sell NVIDIA and buy something like CVS or Innova, and you're not generating a taxable transaction. So that allows like a modulation, like the rebalancing. In the same way, if you own the S&P 500, it's just rebalancing, and you don't know, you're not getting a tax bill at the end of the year. I recommend folks go to Lumina ETF, fill that out. It takes just a minute. I'm intrigued about that. We're very excited about all the stuff we're doing here. Thank you again, Michael, for joining us. We'll have to do it again soon.
Thank you.
And again, folks, listen to the first interview with Michael from May. I call it's a foundational interview, and I'll really provide deep perspective on AI and tech and semiconductors and transformational long-term visioning as well. So very powerful content there. Thank you, Michael. Until next time.
Thank you. Thank you. I'm looking forward to number 3.
Exactly. Hey, Michael, that was.
Thank you for listening in on the episode. Remember, in the world of investing, the road less traveled often leads to the greatest rewards. I'm Ram Alawalia, your host and Chief Investment Officer at Lumina Wealth, where we specialize in the craft of alternative investments. Invest wisely, stay ahead of the curve, and stay non-consensus.